we've got a great divide. Ellen Zettner over at Morgan Stanley says a few rate cuts. Jan Hatzius over at Goldman Sachs says more rate cuts. Which will it be, and what does it mean for my portfolio?
So we're taking a kind of conservative view of what the Fed is going to do over the next 12 months. We think what the market is priced in, kind of call it at least 3 over the next 12 months is where we're going to stay. Look, I just want to, listening to Howard Marks and kind of going through back to our conversation, I just want to pose an idea.
Please.
What if we are all being too conservative? We keep on asking what could go wrong. Is the Fed going to over-tighten? Are earnings going to disappoint? Will revenues not be in line? Do we have to worry about Brexit? Are there other policy and political concerns around China and U.S.? What if things look pretty good? What actually would we do if growth continued to be in a nice, sustained global economic expansion, the global economies were, and we had companies continue to produce solid earnings, and everyone has gotten so conservative?
Do you own the same stocks under a Hatzius view that you would own under a Zettner view? Does it matter in terms of portfolio selection to be the courage to be in the market under those two scenarios?
Look, I think that the number of rate hikes matters a lot for the more defensive and rate-sensitive sectors. So I think that's where we can see things on the margin. But I think your question also, Tom, is about how worried should we be about the number of rate hikes for all companies? And the work that we've done has suggested that companies are still not that sensitive to higher rates. What I'd be watching very closely is what happens on the consumer side, because the consumer doesn't seem to be as prepared and hasn't done as good job of sort of shoring up their own balance sheet and their debt profile as companies have done. And so if that ends up pushing back on consumer demand, well, then that could have I think an impact that we don't have forecast right now.
Kate, what would a policy mistake look like from the Fed, and what would that do to equities?
I think a policy mistake would be all of a sudden to abandon their framework of being data dependent. It seems, I'm laughing a little bit as I say that because it seems extremely unlikely that that's going to happen. But if we were to have some significant acceleration in the pace of rate hikes, I think that would scare the equity market considerably. But as long as we are communicating, as long as the Fed is very clear about the data that is important to them to make the decisions, I don't think the equity market should be shaken. I think that the sentiment pullback and therefore reaction in prices that we've seen over recent weeks and frankly all of the third quarter has so much to do with geopolitics and policy and the U.S.-China relationship and less to do with what's going on the ground. This is why I'm posing this idea. What if things could potentially go right? And, are people's portfolios positioned for that outcome? I would suggest that they're not.
I mean,
Kate, and I don't want to push back. Sorry, Tom, go ahead.
I just was going to say that's too much optimism for Monday morning.
Okay, I was going to push back against that, Kate, just because there are so many risks out there, right? So you're right, it could go right, but is it 60-40 if it goes right? I guess you have these idiosyncratic risks, which could be emerging markets, it could be geopolitics, it could be, more, politics being put in place that aren't good for the economy. And how does the market, what's it pricing in right now?
Yeah, Francine, that's a good point. I mean, in general, we think that the range of growth outcomes and the range of policy outcomes has broadened from where we were, say, 3 or 6 months ago. But we always tend to focus on how it's broadened to the left tail and not how it's broadened to the right tail. And it's possible that actually, the tax cuts in the U.S. with strong underlying demand lead to sustained growth. And we see, top line look pretty good. I was reading some of the papers this morning, and there was an obsession about how a number of companies have not met the revenue expectations for the third quarter. It is super early in earnings season to make this estimation. And I think analysts are not expecting an acceleration in the second half of the year. We're talking about, 8-9% revenue growth, which is amazing 9.5 years into the cycle.